earns a more appropriate return, and that increased capital spending by 75%. And the next slide actually shows the capital spent for expansion, which is that is to replace, not just replace, but add to the amount that we have on in the physical plant. And you can see that there's a direct correlation. And one thing that I would like to point out, we did have a presentation from WCTL. We've said publicly that coal is our lowest earning business, and that's just an aside point. We have seen significant growth at BNSF over the last 10 years, and that volume's gone up by 50% over that time period. And we all know that we have the Cambridge study, and then we also have an AASHTO study that shows that there's significant investment coming. And I would say that Cliff Eby did a good job of explaining the fact that we do have significant expansion needed to keep up with simply the growth within the economics of the United States. So let's get down to the punchline. As I previously discussed, our investment decisions are all about risk and returns. And understanding the industry cost of capital, understating rather the industry cost of capital, creates a significant risk that jeopardizes those returns. And if we can't earn adequate returns, we don't make the investment. Now, WCTL states that there is a relatively low risk in the railroading business as justification for a low beta. And I would argue that with recent changes we've seen in our business, like imports from China, higher fuel prices, economic legislation, ethanol, and also on the horizon we have future carbon legislation, we have the opening of expansion of the Panama Canal. There is significant risk in our business. And in 2007, I'd say that's a good example. We've got our coal business is flat year over year. Our agricultural business is the one business that is up. Our consumer business, which is intermodal, is down about 7%, so significantly year over year, and our industrial products is down. And those are all driven by different factors. But 85% of our business is flat or down on a year over year basis. So again, the WCTL says we should take a common sense approach. Well, I'd argue that a beta of less than 1 with the risk in our business and a cost of equity of less than 10 does not pass that test. So finally, to conclude, let me address the appropriate cost of equity. And in written submission to the STB, Atticus, who's going to testify in a few moments here, uses a range of 12 to 15%. The Children's Investors Fund uses 12 to 14%, and the DOT said 10 to 12%. As I mentioned before, at BNSF, we use a hurdle rate of about 15%, but I have to tell you that our internal range of the cost of equity is generally in the 11 to 13%. And we agree with the thoughtful comments made by the DOT regarding the need to avoid shocks to the system, because the board should not implement any changes, or the board should implement rather changes in a gradual and thoughtful way. And I urge the board to use caution in making dramatic changes, as many times when these approaches are implemented, unintended consequences take place that are not always anticipated beforehand. So we need to be careful not to shock the system. I also urge the board to consider the overall methodology for revenue adequacy, including the asset base. And I also want to go on the record as saying replacement cost is something that needs to be seriously considered, and BNSF is in favor of. The STB is the long-term steward of the health of the rail industry, and using future projections of capacity as the backdrop, you have the choice of implementing policies that encourage private companies to make the investments to address this increase in demand, or you can implement policies that would help some shippers in the short term, but in the long term create problems for the system and the nation. Thank you.
Thank you, panelists. We'll now turn to questions. I'll start it off if I could. A couple of the witnesses did mention their own company's cost of capital calculations or in passing, or I think it was Mr. Romig who mentioned that the NS uses both a CAPM and a DCF model, that's fair to say, and Mr. Hund talked about a 15% number, then also, I guess, if I heard correctly, a number they use more internally of between 11 and 13%. Let me just ask each panel, if I could, what cost of capital figure you use at your railroad and how you calculate it. I'll start with Mr. Romig.
Thank you, Mr. Chairman. Norfolk Southern has not disclosed its cost of capital calculation, and so it would not be appropriate for me to comment on exactly what it is at this time, but it's in the range addressed and spoken to by the other rails in their testimony here today.
Mr. Barros?
Clearly, the Kansas City Southern is in the same boat as Norfolk Southern in terms of its disclosure of its cost of capital, but ours would clearly be a little bit higher, more towards the high end, like BNSF, where we would say our hurdle rate would be higher. Our cost of capital is greater because of the various inputs that we would focus on in terms of achieving shareholder returns.
Mr. Bohr?
We use multiple analyses at CSX. One of the aspects of it. We use multiple analyses at CSX. One of the aspects of the DCF method is forward-looking, and we absolutely, when we build our business plans, try to be aware of where shareholders see opportunities and expectations for CSX, and take those into account in doing that. When we make investment decisions, we use a discounted cash flow analysis to do investment decisions. We have hurdle rates, as has been mentioned, that is exceeding cost of capital estimates because we think that's an appropriate way to deal with some of the risk inherent in the rail industry. The comments we haven't announced a specific cost of capital publicly, but the comments that are being made at the table are consistent generally with where CSX is looking at matters as well.
Mr. Hunt?
Okay, well, obviously in my testimony I said that we were looking at a cost of equity in the 11 to 13% in our analysis. Internally we use a variety of methods. We use DCF, we use CAPM, and we use a no-pat type of methodology, and so we don't focus on just one in the way we do things. Converting that over into a cost of capital using kind of the weightings that the Commission has used, that probably equates to a 10 to 12% type of range.
Mr. Young?
We use several methodologies internally here. I haven't been the CEO here or CFO for about 3 years, but I want to turn it around a different way here. It's around that cost of capital comes out in that low double-digit range. What's most important, though, is what happens in the boardroom in the decisions. We have a hurdle rate that's 15 to 20%. You do your own risk adjustment when you look at making investments, likelihood of the markets, et cetera. You draw the line in terms of where you look at these returns, but ultimately it comes down to cash flow in the business. This is a cash-intensive business when you look at it. I'd like to tell you there's a real sophisticated model that we check off in every capital investment. It starts with that, but the reality is, and we're in the process of planning our capital spend next year, you look at what you generate from operations, what you pay in a reasonable dividend, what's left over to put back in investment or return to shareholders. And the margins are pretty tight when you look at the spreads between cash in and cash out. So you have a process that establishes a priority, but in reality it comes down to really your cash strength of your cash flow.
As a follow-up to that, and I'll ask let any and all panelists respond to this, starting with Mr. Young, would that argue then that we should consider something along the lines of a modern three-stage DCF model that focuses on cash flow yield?
Mr. Chairman, I'm not going to get into the technical detail here. You can ask a couple of the guys next to me. My concern is this. Pretty simply, when you first came out and you cut UP's cost of equity from about 14 to 7, that concerns me. Because the implication, and what we haven't articulated today is, what does it mean when you're revenue adequate long term? My gut says it doesn't give me more rate flexibility. If anything, I would assume that over time we're going to have greater pressure on rates. And again, you take that and put that into the context of cash flow for the business. It will, no question in my mind, if we get this wrong, the slope of growth investment will be decreased in the business.
Thank you. And if I could just follow up on that, just so I know we have some members of the press here and want to make sure the facts are clear. We have put out a notice of a proposed rule. We're getting comment. This is the second hearing. Of course, we haven't actually cut anybody's cost of equity or capital in any final sense, so we just want to make sure that's understood. I think it is, but just to be safe. Would anyone else like to speak to the question of the utility and the helpfulness of using a cash flow yield-based three-stage DCF?
This is Bill Roaming. I'd like to just say that it's not so important what method the board chooses as it is whether the method they choose has a realistic result. And the realistic result is a level of allowed return on capital which attracts capital to our industry and not drives it away.
Yes, Chairman Nottingham. The Kansas City Southern would go on the record to say that our conclusion has been that whatever methodology the board would so desire to look to as the standard is fine with us. It's the inputs that go into that, and recognizing the diversity of risks and cost structures in our industry, and saying how would that be different for, say, a Kansas City Southern versus some of the other larger railroads.
And from our point at BNSF, I mean, actually, Commissioner Mulvey mentioned that aren't we trying to estimate the same thing using different methods, and that's exactly how we view it. And so really the panel before us talked a lot about examining the deviations, and I mean, I don't think that we'd be opposed to that. We'd be very much focused on are the inputs and whether you were getting significantly different answers by using one method versus another. But I'm back to the using the common sense approach. At the end of the day, if we come to a conclusion that the cost of equity is 8.5% or something like that, I mean, I'm back to the points that Bill Romig made. That doesn't justify investment in this as a stock or in this as a business.
I certainly, as just one board member, will say, I certainly respect any business's reluctance to offer up sensitive self-assessment or internal data about business's strengths or weaknesses on the balance sheet, so to speak, or in the cost of capital area. But I will say, and you must realize this, we all expect that any business as sophisticated as the Class 1 railroads before us looks at these numbers constantly internally for your own reasons and to meet your shareholders' expectations, and just the fact that you seem to be reluctant to offer up your actual own cost of capital determination could open up a line of critique that the line would be that if that number were to help you in this proceeding, you would open it up. So I'll just give you one other chance if anybody wants to.
I'd like to comment on that, Mr. Chairman. As you know, we're public companies, and we're subject to the regulations of fair disclosure. And to the extent we have material information which we have not disclosed publicly to our shareholders in the manner in which the law requires, it would not be appropriate for us to do so here today. And it's not that we don't want to share that with you. We've given you input, or at least I have, and a couple of the other panelists have given you input as to where their numbers lie in a range. But I think that to not disclose it this time is the prudent thing for us to do if we have not already disclosed it publicly.
Mr. Chairman, can I comment? I think at the end of the day, it's what our investors' assessment. There aren't many secrets in the railroad business in terms of what we do. What's most important is when I sit across the table from shareholders, how do they view the business? They have their calculations. They vary. There's one comment I heard out of the experts is whatever we pick probably is 100% right. That's out here. And so I'm not quite certain at the end of the day what I've said publicly, low double digits. I'll continue to say that when you look at our cost of capital. And I can find methodologies that can support a pretty wide range of numbers. But ultimately, it's the investor sitting across the table from you that'll make that determination. And as I said in my comments earlier, I think when you have that kind of spread, we should ask the question, what do we do to incent investment in the business going forward? Clearly, investment will follow the returns.
And maybe I used too many words around mine. I thought I answered it pretty directly. We don't use one method, variety of methods. Cost of equity, 11 to 13%, using kind of the midpoint of that cost of equity. Cost of capital, using the weighting that the board uses, 10 to 12. Is that direct enough?
That is very helpful. Thank you. Just as a follow-up, I'm cognizant that my board colleagues deserve a chance to ask questions, and they certainly will get that very soon. Let me just ask, though, in looking over this record and thinking about your statements today, it occurs to me that each of you probably spends a fair amount of time dealing with analysts, dealing with investors, dealing with customers, of course, looking at numbers such as the ones we've been discussing today. I guess I'll ask two questions. The previous method the board has used up until now for measuring cost of capital, was that, in your view, highly relied upon by analysts out there? Is that something, because when we look at the record here, we see different parties have submitted 6, 7, 8, 9, 10 different private sector, Morningstar, Value Line, et cetera. And one concern we have is, we have our own reasons as a regulator to, obviously legally, to develop this number, but it would be nice if in doing so we could actually get a number that's somewhat useful to analysts and to the marketplace. And then the next question would be, in hand with that would be, do you think we'll ever get, despite our best efforts, will our number ever be really widely used by the private sector in analyzing your cost of capital, or will other firms' numbers like Value Line, et cetera, really continue to be what's used out there? I'll let Mr. Romick, you want to start with that? Or?
Yes, and in fact, I was on the road last week talking to investors in 3 cities in the Midwest, and what they were concerned about is the uncertainty that the proposed rulemaking made or resulted in for investments in the rail industry. And I think that the prior rulemakings, the prior cost of capital, didn't present them with the more imminent prospect of the industry being declared revenue adequate. So I think it's a practical matter. They weren't worried about it. They are now. And if there's one thing that markets hate, it's uncertainty.
Mr. Barros?
Not dissimilar, where our shareholders, I think right now, more have a focus on. Clearly, you're all aware that we're more of a growth company trying to expand our franchise between the U.S. and Mexico with a cross-border network, right? And the availability of capital, the fact that we're a higher investment risk than some of our peers that are Class 1s, and we're just not as large. And so therefore, what happens is that we have less access to some of the capital markets. Also, our shareholders expect more, and our cost of capital needs to reflect that, because there is greater risk with our size railroad than there is with some of the others.
Mr. Moore?
I think individual investors have their own view as to what cost of capital is. They don't look to the STB or to CSX to tell them what that is. I think an important context as well is to recognize the nature of the reason why the question needs to be asked. Applied in a regulatory setting for purposes of placing a cap on revenues is an entirely different question from making an economic decision with respect to an investment. For all the reasons of risk, for all the reasons associated with using hurdle rates that are in excess of the cost of capital, all those are very germane to the economics of the rail business. And so it's a much different question to say, at what point do I freeze and cap the ability to get a return on cost? And so that's the nature of what's so difficult about this question. So we come here today sort of looking at maybe a simplified method that was adopted 25 years ago that says I'm going to use one growth rate assumption instead of a more sophisticated, multiple complex assumption. But we recognize that the whole area has its own set of difficulties, as I tried to bring out a little bit with the replacement cost issue. So to be short to your question, I think it's in the eye of the beholder, and you do get different answers from different parties.
Thank you, Mr. Holmes. Would you like to take a shot at that?
Certainly. You asked, I think, a couple of questions. One, in the past, has the cost of capital and cost of equity of the board been used by Wall Street? And I mean, I've been part of the face of our company for almost the last 10 years on Wall Street, and I would have to say no. I'd say it generally has not been used. In the future, I think was your other question, it's possible, but I think that's, as David pointed out, the analysts, both on the buy and sell side, really do form their own opinions and use other inputs as a data point, if you will, to either verify or question where they are. I also want to reiterate a little bit of what David said, though, is, as we do change, and if there is a cap and perhaps an artificial cap placed upon rates, what that is going to do is actually increase the riskiness of the business, increase the beta, if we go back to the previous testimonies, and therefore, has a risk of having the unintended consequence of actually raising the cost of capital here.
Mr. Young?
Mr. Chairman, there's some range when you look at an individual investor doing a cost calculation. Again, it depends on their investment timeline, but good long-term shareholders in this business, they have a cost capital calculation, but 90% of the discussion is spent on cash flow. They are very concerned about what is left over for shareholders after we cover our costs, invest in the business, That's the starting point of the discussion. And the issue is one that jumps out every time when you look at this industry. Tom, or one of you had a slide. Union Pacific this year will invest about 2.5 times its book depreciation back into the business. That's pure cash when you look at the implications here. And that is where we spend most of our time with our shareholders, their interest in what are the issues we're facing long term, what are the replacement costs of assets, and how do we see our cash flow moving?
Thank you. Let me, if I could, Mr. Roman, did you want to jump in real quick? 'Cause I want to turn.
Yes, I'd like to add
Commissioner Mulvey next.
add one point here. If we go back, you can find instances where the investors and the analysts on Wall Street were very concerned about the levels of railroad investment. And the reason was the railroads had very low returns on that investment. Over the last 3 or 4 years, those returns have increased. And now we actually see railroad analysts saying, well, keep the money, don't send it back to us, invest it in the business and grow so you can earn more profits in the future. And that's what we would like to see. If our rates are capped or if there is an unrealistic cost of equity imposed upon us, we're likely to see the old days again.
Thank you. Let me yield for questions from Commissioner Mulvey at this point.
Thank you. A couple of things that came up at the hearing. Mr. Hunt, you said that the coal is the lowest earning business or one of your lowest earning businesses, but of course coal is utility shipping coal is mostly captive traffic, and when we look at the revenue to variable cost ratios for coal traffic, they are often allowed to be fairly high. How do you justify saying that coal is a low earning business? Do you simply mean rate per ton mile?
No, it's actually based upon our own internal return on invested capital. So when we look at our entire network and split the denominator, if you will, all the investment to all the various pieces of the business, and that basically was split in 4 ways: coal, agriculture, intermodal or consumer, and industrial products, and then look at the returns we get over those. Coal is mathematically at the lower end, it's the lowest of the 4, and we've said that since 2006.
CSX, you had in your presentation, I believe it was on page 3, the transportation capital investment in billions of dollars between 2006 and 2010. Is that in real or nominal terms?
Those numbers are in real terms.
Those are in real terms.
They're estimates, but yeah, they're in real terms.
Okay, thank you.
I'm sorry, they're in fixed dollar terms. They're
Yeah,
the dollar amount.
real dollars, constant dollars. Okay. Have the railroads, any of the railroads, issued new equity in the last few years? Or we talk about the return on equity and whether or not the railroads can attract capital, but have there been any new equity issues in any of the railroads in the last few years?
In 1998, when the UPSP had its challenge with putting the companies together, and again, this gives you some perspective on the risk profile, we were bleeding cash and we went to the market for kind of a hybrid called a convertible preferred offering, someplace in between debt and equity, borrowed $2 billion. And we worked pretty hard to get the financing.
Anybody else new equity issues in the last 10 years, 20 years?
We've had a